Hello everyone and Happy New Year. I am Robert St. Clair and I'm a strategist with Fullerton Fund Management. The video that you have just seen shows us what happened over last year. The global economy was hit with a very painful recession and is still fighting COVID-19. Against that backdrop, I would like to welcome you to our Investment Outlook webinar. The future is likely going to be very different from the past, and investors need to adapt to a new normal and change their investment strategy as the changing world unfolds. To answer this question, we have brought together some of our key experts to share their insights on the latest investment trends and where they see the opportunities lie. As you can see from the agenda on screen, we will be covering a range of issues across most of the key asset classes. First up, our CIO Patrick Yeo will share his investment outlook for 2021, and that will be followed by a sequence of panel discussions where we will go through fixed income and then into equities and then into alternative assets. At the end of each session, there will be an opportunity for you to ask questions and also participate in polls, and you can do that with the slido.com application and follow the instructions that are on screen. I think without further ado, I will pass over to Patrick for him to share his thoughts on the outlook for 2021.
A very good morning and a blessed new year to our valued clients and everyone. 2020 had been the most unusual year for all of us, having to cope and adjust to a different normal. For investors like ourselves, we have to navigate through compressed market adjustment. We've seen one of the fastest bear markets. So between February and March last year, the US equity market fell by more than 30%, and there was huge disruption in Asian credit markets. Subsequent to that, we witnessed one of the fastest recovery. US markets were up more than 60%, and it's even greater than the GFC. You have to go back to the recession era to see a stronger recovery than that. Secondly, we've seen high correlation in markets. In the first quarter, represented by the blue bars, you see equities market, credit market, industrial metals all fell sharply while the US dollar rose. And in the subsequent recovery, you see all these assets recovered very strongly and ended the year strong, while the dollar turned around and ended the year at minus 7%. In this condition, we also witnessed a huge divergence in the performance of countries, sectors, and stocks. So that actually presented an opportunity for active managers like Fullerton to seize those opportunities and perform strongly for our clients, which we did. The third point here I want to make is that we have also seen rising gold and metal prices. And that is a hint of inflation concerns, given the QE quantitative easing that we are seeing, as well as the continued fiscal spend. It will be for investors who were with us in January 2020, we at Fullerton asked investors to stay the course together with us, although the outlook will be uncertain. And that has certainly panned out in terms of the support from the government, monetary and fiscal policy. For some fiscal stimulus, many countries are even greater than the GFC. So at Fullerton, we stayed the course and also reaped the benefit. Now, with the support from the governments in the credit market, we did not experience the painful debt deleveraging that we saw in the GFC, and hence, you will look in the chart compared to 2009 to the GFC, earnings did not collapse that significantly. And now going forward, what are our expectations? We see stronger growth forecasts driven by consumption that will transit to investment demand. and will flow through eventually to industrial production growth. And in that environment, it continues to support corporate earnings. Where we are today, with the vaccine development, the end of recession, and continued policy support, we have seen reduced uncertainties and hence also low expected volatility. So in that kind of environment, we have seen asset allocation right from the beginning of this year tilt towards equities from bonds. And here I want to show our proprietary regime framework that analyzes 4 factors, right? Growth, liquidity, inflation, and risk appetite, as well as the rate of change. So this is an 8-factor model that helps us to identify the regime that we are currently in. So the regimes are danger zone, which is in red, recovery in green, Goldilocks in yellow, and late cycle in purple, and blue represents a sentiment-driven scenario. So here, based on our model using data science, we are in the Goldilocks environment. And what does that mean by a Goldilocks environment? In that kind of in this regime, Asian FX, equities, credit, and copper can do very well, while the dollar will come off. Here I want to talk a little bit on the outperformance of Asia. So you see in here, we have the growth differential of 4% between EM Asia and DM market. DM market will experience growth of 4%, while EM Asia will experience growth of 8%. And coupled with strong current account fundamentals, as well as better relative inflation outlook in Asia versus developed markets, we will see a outperformance of Asia, continued outperformance. We have seen that last year, and we expect that to continue into this year. And even on the financials indicators, real yields are relatively attractive across Asia. We believe that central banks in Asia is not likely to ease further, except with the exception of Indonesia and India, which has rates close to 4%. We have penned in the 25 basis point easing there, and hence demand for carry will support markets with positive real yield. And here we have shown in the solid lines Indonesia, Malaysia, and China, relatively higher, much higher real yield than the developed markets, which are represented by the dotted lines of US, Europe, and Japan. Now here, this shows the flows into the stock exchanges of the Asian markets. We have seen in here that in the last 2 or so, or 3 years, where a cumulative 80 billion has flown out of these Asian markets. And in just the last 2 months or so, we have seen a sharp reversal of this flow. So we believe a continuation of such flow back into Asian exchanges will also support the Asian markets. Now this is my concluding slide. Fullerton has a positive outlook on risk assets. We are bullish on equities, especially Asia-related equities. We are positive on industrial matters as GDP growth rises further, as well as for alternative assets, including gold, because these assets has investment horizon that are less sensitive to shocks. While we are negative on US bonds and also negative on the US dollars. I will stop, I'll end my presentation here, and certainly myself and Robert, our strategist, can take questions from you.
Thank you very much, Patrick. A very comprehensive overview of the outlook. And I guess some of the key takeaways for investors is that strong growth outlook, plenty of liquidity, and we are moving into this Goldilocks environment, which I think is quite an interesting way to classify the data because it has been quite strong. Perhaps one question that springs to mind, given your bullish outlook, is what is the key risk that worries you the most looking forward?
Yeah, I think one of the key risks is certainly a sharp rise in interest rates. And we have seen that, just right at the beginning of the year, 10-year bond yields has risen 25 basis points. I think when interest rate rise based on asset allocation shift, we have seen, as well as a better growth forecast, and I think the markets can bear. But when interest rate rise due to sharply rising inflation expectations, as well as adjustment in risk premium, we know that in the US curve, the risk premium is negative and very low. And thirdly, of course, the market inability to absorb the huge supply of US Treasury. We have seen, the net supply this year is likely to be 1.8 trillion, and that is more than, if you look at the past 10 years, right? The last 3 years, there were 3 years that has got net supply of 1 trillion. So it is the question of whether the market is able to absorb such supply. If not, then how would interest rate react? The second issue is, of course, valuation of the market. So we have basically based on static measures of price PE, price to book, trailing ROE, markets are expensive. So markets are generally currently supported by low interest rate, expectation that it will continue for the foreseeable future, as well as I mentioned earlier on, the higher growth expectation, and therefore, much higher earnings than what we have seen in the last 1 year. So these are the two risks that we need to bear.
Understand, because we actually later on today we will talk about the valuation issue, because I think it is becoming a lot more concerning to investors. Just to touch back on the inflation risk that you talked about, do you think, I guess, one key kind of signpost to keep watching is that forward inflation expectation? So I guess so far it's kind of around the 2% mark, but I guess if it was to jump a lot more than that, then that would increase the risk that we could get a rapid
certainly
adjustment.
in our discussion, daily discussion, this is something that we want to watch out for. And the current rise in yield, right, is also on the back of some adjustment in inflation. And I talked about earlier on, the gold price rise, as well as commodity prices rise, and that could portend a higher inflationary backdrop further down the road. As well as what we have seen also, right, in the first quarter of last year, these commodity prices, oil prices are low. So going forward, the base effect would also cause some inflationary, headline inflation to be higher than market could expect.
Thank you, Patrick. Maybe we take a look at some of our questions from the audience. And this is an interesting one, is I think kind of is related to what you think is the most significant risk. But when you're thinking about asset allocation going forward, I guess you could adjust because of positive things or negative things. How are you thinking about asset allocation, and what could cause you to shift going forward?
Right. Certainly, I think currently, in terms of asset allocation, we are overweighted equities, underweighted bonds. So that is predicated on the regime framework that we have, right? We are in a Goldilocks environment where equities will outperform bonds. As well as in terms of the political situation in the US, we have a blue wave, and that beckons back to 2009. We had the same thing, and in that environment, also in an environment where we experienced a sharp economic recovery, equities market did well, and bonds were negative. So I also mentioned that valuations is expensive, but it is currently supported by flows in the market. So what would cause us to change our view or shift our asset allocation? One is, the regime change, right? And maybe I back up a bit to think about how well the market can recover. We are into the second year of a recovery, market recovery. What we are talking about is after a 30% down adjustment in the market downwards. Last year was the first year of market recovery, so the second year. If you go back to 60 years, we have 5 or 6 episodes of such adjustment. And in the second year, which we are currently in, the median adjustment is 16%, right? So then it also comes back to, and we have also seen how compressed market adjustment can be. So in the sense, if markets were to adjust very quickly in the next, say, 2 to 3 months, say up by 25%, then we have to examine as well, right, in terms of what is the regime that we are currently in, and whether it has moved to a danger zone or a sentiment-driven regime. Then other factors that we will look at, of course, will be the technical factors. An overbought condition, we are generally still, perhaps the market could hold. But if it's a sustained overbought situation, then we have to be also wary. And other indicators when we will look at will be the breadth of the market, also the consumer discrete versus consumer staple, the relative performance of those. And I think other indicators that we closely look will be the volatility, right? The volatility term structure. As in, we examine the short-term volatility of 2 months and 5 months. So if in the event when short-term volatility rises above the 5-month volatilities, then we will have to think about whether the market is signaling a risk. But of course, all this must be taken in the context that we will constantly monitor the market situation based on our regime framework, based on the fundamentals work that we are doing to adjust and just to reiterate that market move very fast, and we have to be nimble as investors to or fund managers to look after our investors' portfolios.
Yeah, because I think it's a key point that you made, that the moves we saw last year were quite unprecedented in terms of the speed of adjustment.
Yes.
And I'm just wondering, you make quite a key point, I think, about changes in the breadth of the market as the rally matures. I guess it's, at least from an economic perspective, GDP, the recession only ended sort of last year, so it's early days in the economic recovery. I'm guessing that given the strong growth forecasts that you have shown us that the IMF is expecting, as well as the consensus, do you expect, I guess, that should feed through to earnings and will broaden the rally as time goes by?
Certainly, I think growth expectation is likely to feed through. Unless we have another shock, which currently based on the reading indicators, the Western developments, I think that is a low probability event.
Thank you very much. Let's take another look and see what questions. Okay. Of course, I think one issue, of course, is geopolitical risks, and we know there's, I guess, a lot more political uncertainty given the popular unrest in the US. But I guess those things will work themselves through as the administration changes. But I guess maybe looking a bit longer term, you did make the point that democratic policies can actually be quite favourable, at least to equity performance going forward.
That's right. So I think in view of the question about the US and the Biden administration, I think on the US, I mean, our view is that the transition will proceed. There will be increased safeguard, and Biden administration will be a cautious one, a process-driven one, unlike the Trump administration where there are more abrupt policies. I think in terms of focus, he will focus on the domestic issues of the economy, of climate change, and these are policies that are less divisive. I mean, given where we are in the US currently, and on his policies about increase in corporate taxes and increase in personal taxes for the high-income earners, those are likely to wait until the economy has a stronger footing. So priority would be to have fiscal spend on infrastructure, on healthcare, and perhaps even cybersecurity. So on the US-China kind of tension, the unfortunate thing is that the strategic competition will always be with us, right? Will always be with us. But I think the administration will also want to avoid direct confrontation. In the area of tariff and sanction, they will also examine what is the strategic US interest, right? But I think in the relationship, I think the fresh point would likely come from perhaps Hong Kong relating to the national security law, or in Taiwan. So but generally we are sanguine about
Right.
going
And
forward.
we will have more opportunity to talk about some of the geopolitical risks later. It's probably time for us to move on to our next panel discussion. So thank you very much, Patrick, for giving you our insights. For fixed income, to transition ourselves into the next panel discussion, we have our first poll question that you can participate in through the Slido. And it's quite poignant, I guess. It's how are you positioned in a low rate world going forward? Welcome back, everyone. We're now going to discuss the outlook for fixed income. And of course, from the macro backdrop, we know this is a difficult environment because we have low inflation and low yields. And so it is harder for, I guess, fixed income investors to find sustainable returns. To discuss these issues and opportunities that we see in fixed income, we have Ongwat Cheng with us. She is head of fixed income at Fullerton. She manages the Asian fixed income portfolios and strategy, including local currency and Chinese bonds. And then we also have Isaac Chow. He is a portfolio manager responsible for Asian credit portfolios as well as the absolute return strategies. Maybe before we talk about the outlook for fixed income and strategy, if we take a look at the response back from our audience poll to see how people are positioned. And actually, it's a little surprising to me. I think that the strongest outcome has actually been perhaps, well, not surprising in some ways that people are actually allocating more to equities. But I did think that maybe equally we would find people still committed to being short US duration. That comes in at the third ranked score there. So yeah, quite interesting findings. I guess because the outcomes are also kind of split across the options, it does suggest to us that people are following a multi-pronged strategy to navigate this low rate environment. And of course, allocating more to equities is an obvious response. But if we think about the fixed income side of things, and maybe if we come back to Guat Cheng, excuse me, and just think about the US outlook, that's obviously very important to how we think about fixed income. So perhaps you could share how the team is thinking about the US outlook and what it may mean for Asia.
Thank you, Robert. So what we have seen is the US economy recovering since the trough in the second quarter last year. Has been a V-shape between second to third quarter. Second half was largely recovery story. That momentum will continue into 2021, especially with the vaccine implementation. So this is a year of US reflation. So from a bond investor perspective, then the natural concern is that does that lead to actually inflation expectations rising excessively, and hence that impact also on the bond yields. So we actually seek comfort in the Federal Reserve's US Federal Reserve's guidance, which is that they will be staying on hold at least till 2023. This is really measured against their twin policy goals of achieving full employment as well as keeping inflation close to 2% on average basis. So versus that, those policy goals, their projections basically indicate that they will only get there sometime in 2023. So we take comfort in that basically rates will stay low for longer. Then the question is on the longer end, will actually bond yields be so-called unanchored due to inflation expectations running ahead of itself? So on that front, I think the Fed policy actions will also play an important role. The latest guidance from the Vice Chair, as recent as last week, was that the Federal Reserve will continue on its asset purchase. Right now, the pace is 120 billion worth of bond purchases per month. That monthly pace will be maintained at least for this year. And then next year, I think really depending on the pace of recovery. So I think that the key indicator other than inflation picking up is that we are still quite far away from achieving so-called the full employment target that US looks to achieve. So on that basis, we think that US rates will be in a moderately rising environment there could be bouts of volatility when market expectations sometimes overshoot itself. But by and large, we are looking at US 10-year Treasury to reach in the range of 1.25% and 1.5% by end of this year. And that generally, I think, would also be quite supportive for Asian credit bonds as an asset class.
Right, I think that's a key point too, and I guess that with Asia's strong fundamentals and the backdrop that you have painted from the US side, probably on balance there could still be more US dollar weakness to come through, and I guess if we do see maybe more capital flows into Asia, in particular to fixed income where they're looking for favourable yield, there could be currency support in this part of the world. Is that kind of your sense in terms of how things might balance out?
Yeah, exactly. I think you've touched on a few key points. One in terms of capital flows. So typically in terms of where we are right now in the overall global cyclical upturn, that is actually a phase that is supportive for risk assets and supportive for emerging market assets in general. So last year we had volatility in terms of sharp outflows in the second quarter out from emerging market, especially bonds. We saw recovery of that in second half. We expect that to actually continue on a much steadier pace this year, mainly supported by the fact that rates are low on a global basis, and more importantly, as you rightly pointed out, Asian fundamentals are strong. We are basically looking at from bottoms up recovering earnings, and also on a top-down basis, the policymakers will continue to adopt a accommodative stance in both monetary as well as fiscal policy. So that will be supportive for growth. And finally, in terms of the overall valuation, real yields are actually positive and attractive in some of the local markets, and currencies are generally not expensive. So the Chinese renminbi will be a key anchor, I think, in terms of currencies in this region. And generally against medium-term dollar weakness, we think that Asian currencies have scope to appreciate more against the US dollar.
I think that's a very comprehensive answer. Maybe if we stay on this positive Asian theme and turn to Isaac, I know that you look after corporate credit within Fullerton. What's your sense on the outlook for corporate credit in particular across Asia?
Yeah, thanks. We definitely like Asian bonds indeed. And in that context, the hard currency US dollar bonds offer attractive carry. And on the back of improving corporate fundamentals, Asian corporates over the course of 2020 was beaten down by COVID-19 situations, and had really gone through a doldrums in terms of their business operations. We see that reverting back to more normalcy in 2021. And with that, if you look at the financial matrix terms, we expect the improvement in EBITDA, the measurement of profitability, to improve and outpace that pace of growth in leverage and in debt. So the net basis will be an improvement in financial matrix across Asia. And with China being arguably one of the first countries that have successfully contained COVID-19, we expect China to provide the leadership in terms of intra-regional trade and exports, and subsequently through services. So that will provide a leadership and string along the rest of the growth in Asia. And for that, in terms of positioning in the portfolios, we are overweighting corporates and for high yield sector as a general sense to capture the upside of economic recovery. And while investment grade sector, we are favoring the BBB space where there is wider credit spreads to cushion any volatility in interest rates.
Right. Because I think what was interesting maybe for some investors was, last year investment grade performed quite strongly, and maybe this year it's a chance for high yield to perform more strongly, and you have your positive view. I'm wondering from the default risk aspect, given that the recession was so sharp, do you expect default rates to pick up? Is that being priced in by the market, or you think it's still could surprise maybe some investors?
Yeah, that's a good question. In 2020, last year, it has been quite a volatile year for the high yield markets in terms of default cases. We have seen idiosyncratic names in the industrial space in China reporting defaults, as well as some university-linked corporates that ran into trouble. And in addition to the onshore markets, that there were some of the LGFEs, the state government-linked companies. Over in Indonesia, the COVID-19 situation has led into more reticence among the banking sector to extend financing. So that has led to some financing woes in sectors such as the textiles and property sector. So our team has been quite busy in terms of following across all these events last year, and I must say we have done quite a good job navigating through that. Going to 21, on the back of the recovery across Asia as a whole, we expect that default rate to come down. So when we have recorded it, it was about 3.3% last year. They should come down to below 3, so let's call it a high 2% range.
Okay, I think that's probably quite manageable and around historical averages is good. I know, of course, you're responsible for the absolute return strategies within Fullerton, and we've seen how our audience seems to be positioned. And if we think about those just in fixed income space, I guess they're looking to be short US duration, which makes sense, but they are also actually looking for bond options outside of developed market space, and I guess Asia is one area that can be attractive. I'm wondering if you can share some insights in terms of how you're thinking about your positioning and the absolute return strategy side of things.
Yeah, for our position, we're definitely putting our action to where we have and what we have said. So we're overweighting the high yield markets to capture that economic growth and improvements across the financial balance sheets. For that, the valuation in the high yield market still presents attractive entry points, and they're trading at about 60 to 80 basis points above its historical average. So that the valuations are rather attractive. And within that, we are overweighting or have a more significant weight in sectors such as property within the Chinese space. In the investment grade space, interest rates would take a back seat while we expect the carry and credit spreads tightening that will translate into capital appreciation to be the main driver of returns in the investment grade space. And within that, we like the financial side, and the asset management companies carries very strong capitalization and still robust profitability prospects. So we are overweight and positioned in those sectors.
Right, thank you. I know, of course, China is a hot topic, and maybe we come back to Guo Cheng. What is your take, I guess, on China bonds? And I know it's a big topic, but I'm suspecting that you're also quite positive because you did talk about the real yields being quite favorable in this part of the world. Perhaps you could share some more insights on how you're thinking about China.
Sure. Yeah, in local currency terms, Chinese renminbi bonds actually rank pretty well in real yields and actually nominal yields as well. So that's, I think, reflecting the fact that generally the inflation, I think, has been quite well controlled. In fact, it's because of the price, the food price component actually has been on the low front. So the overall, on a real yield basis, I think investors do get more cushion from that real yield as well as nominal yield. In terms of the policy front, we expect the central bank, PBOC, to stay on a relatively neutral mode. So it's definitely, I think, too early to talk about them hiking rates or tightening policy, even though China has been ahead of the rest of Asia in terms of the emerging from the effects of pandemic, negative impact on growth. But we generally see the growth momentum, although it's not likely to be as strong in terms of sequential terms as last year, to continue on pace for this year. And also, in terms of where China is in its medium-term reforms, I think from the latest 5-year plan, the intention and also the implementation will is actually come across strong, that they will continue to push ahead in terms of the medium-term goals, for example, strengthening on some of the regulatory measures, I think including real estate sector, which is sector we like. We know that they basically launched these 3 red lines guidance that was really to promote the medium-term robustness and to improve the fundamentals for the sector. Also overall, I think moving towards more market liberalization in terms of their resource allocation. That's also, I think, a central tenet of their medium-term reforms. So all those we think are positive towards actually laying a broader ground for a firmer ground for China's economy to actually grow in the medium term. And of course, the big shift in growth driver to move away from investments towards consumption is a very key central theme that will permeate across. So all in, we like China bonds, I think, on the fact that overall the medium-term fundamentals are sound. B, on the real yield is actually attractive. And finally, there's a potential currency appreciation for US-based investors. And even for, I think, investors based in this region, the way that the currency is managed is increasingly against a basket of currencies. So as the dollar weakens, the renminbi actually will reflect that broad strength on a basket basis.
Maybe before we see what questions the audience has for us, I put a question that maybe both of you might like to respond to. We've talked a bit about the interest rate risk. If interest rates, especially in the US, rise by too much, too fast, that will be stressful for markets. I guess maybe looking at how people are responding, we could have to worry about an equity market bubble if everyone is shifting allocation to equities.
Right.
But is there another risk kind of on your radar that you worry about that people might not be so familiar with?
Not so familiar. I guess earlier on, it's already mentioned about on the vaccine effectiveness. Right. That probably is a risk factor that permeates across. But aside from that, I think tail risk wise in this region is really down to US-China. Okay. I think the assumption is that the Biden administration would not escalate further the tension that we've seen under the Trump administration. But having said that, we do know that general hawkishness stance against China is actually bipartisan. Right. So the surprise, I guess, downside surprise could be that if there is any episodic so-called flashpoints in terms of the US-China tension. So, within the region, for example, we know, Hong Kong and Taiwan remain some of the potential flashpoints. So if those issues are being escalated, then within the year, we could see bouts of volatility. But that overall, we think compared to the Trump administration, under the Biden administration, the overall, the way of engaging, I think China should be again more revert back to the old model, which is more process-driven, more deliberation versus the bilateral type of style that was under Trump. So all in, we're still positive, but just be aware of, I guess, bouts of volatility coming from this sparks in terms of the geopolitical risk.
Right. No, I think that makes good sense. I'm not sure, Isaac, from your perspective, maybe when it comes to corporate fundamentals and thinking about China, are you concerned about maybe some of the regulatory changes in China itself? I know some equity investors are worried about how regulations may change for their tech companies. Is that something fixed income investors also worry about? Or?
Yeah, sure. We have seen quite a few of these regulatory risks coming down, top down from Beijing down to, and affects the corporates that we invest in. In the short term, we do expect volatility as the players within certain specific industries realign themselves to get themselves in line with the regulations. But in the longer term, we are positive that the Chinese government's perspective is in keeping the pace of growth, the pace of leverage growth in check, and that will result in the longer term a net positive for the industry and for the country itself.
Right. Just taking a look at some of the questions that we have from the audience, and again, a China theme coming through, and Guo Ching can probably help us again in terms of thinking about China real estate. I guess that's another positive call for the team.
So I think as I can elaborate further on from the credit perspective. From the top-down perspective, the Chinese real estate really, I think, is a key sector for the Chinese economy in terms of this contribution to fixed asset investment is very key, the real estate. So with that in mind, I think when policymakers approach towards the policy tweaking or regulation on this sector, they're really thinking about the medium-term perspective. So what they've done so far, I think, in terms of looking to curb potential excesses on overall leverage in this sector, and it's been positive, and they continue to. I think we should continue to expect to see more of these measures coming through. But we actually view this positively because this is actually helping to strengthen the medium-term fundamentals bedrock for the sector as a whole. And in terms of valuation, we are pretty positive as well.
So the, Chinese property is one key overweight in our positioning for this year. And we favor that sector as what Ching has said. On the bottom-up selection basis, we continue to have to look at each individual company selectively and then choose the ones that have the best potential to improve in terms of fundamentals.
Thank you very much. I think it's probably good to end on a positive note for China. So thank you very much for sharing your insights, Guo Ching and also Isaac. Before we move to our next panel discussion, which is going to be on equities, we will give you another poll question, which will allow us to see just how bullish or otherwise people may be in terms of the equity investments. Thank you. Welcome back, everyone. Now we're ready to start our equities discussion. And just to set, of course, the context, I mean, we've seen a very strong rally in equities since the recession ended, and we've had a lot of policy supports come through. Even before, I guess, COVID-19 hit, there was a lot of key structural trends in play that were driving equities. And of course, now people are starting to worry about valuations because the rally has been so strong. We have a couple of experts with us from Fullerton. Ken Goh is Deputy CIO and also Head of Equity Assets at Fullerton. And then Andrew Moore is Head of Equities Research. And a key part of Andrew's job is to integrate our equities research into our investment process. So it's a pleasure to have the team here and to discuss the issues going on in equity. Maybe before we dive into our discussion, we can take a look at the poll that we have canvassed to the respondents. And yeah, quite interesting, at least for me personally. I think that it's maybe a bit more bullish than I might have expected. So the top outcome is to get a 10 to 20% rise in US equities. I guess my prior would have been that given last year's rally was quite strong, maybe this year the safer option would be to have something a little bit slower. Still quite a bit of votes for that, almost 40%. I think what is encouraging is, well, maybe 20%, I guess, are expecting that we could, sorry, misreading. 5% or less are expecting downside, right? So it's very encouraging that it's quite positive.
Equities moves around.
Correct. So maybe given the outlook there being quite bullish, and we heard in the fixed income, of course, presentation that when we canvassed the respondents, a lot of people are actually thinking about, the strategy in this low rate environment is maybe to allocate more to equities. So that could give us more to worry about in terms of valuations. But maybe if we start with you, Ken, just to outline, I guess, you've talked a lot in the past about the key drivers of equity markets, these three kind of structural trends, and perhaps you could share how these are unfolding and what the opportunities are that lie behind it.
Yeah, we see that post-COVID-19 pandemic, we're entering into a different normal. It may feel the same, but indeed is very different. In terms of lifestyle, how we live, work, and play will be fundamentally different as we go forward. That is the first wave we see. The second wave is that technology innovation is really accelerating, becoming ubiquitous, of course, very pervasive, and more importantly, disruptive, creating a lot of new business models, new ways we live our lives, as well as essentially paradigm shifts. Right? The third wave is that thanks to technology innovation, just like what happened in semiconductor industry, this has led to consistent fall in costs of renewable energy, resulting in renewable energy being cheaper than the conventional fossil fuels. Right? And that will bring forth a new growth engine. We call it a green engine, which is very exciting, and many countries are using that as a impetus to really help to drive the new economic recovery
Right.
for many years to come.
Right. Maybe we pick up on that
sure.
on that ESG trend and ask Andrew maybe about the green engine part of it in particular.
Yes.
How does an investor think about sort of how to integrate that, I guess, into their strategy, and what are the sort of, I guess, drivers of the outlook for these compliant companies that can do well?
Sure. So I think that this trend toward ESG and the green engine, as Ken is pointing out, is really being started because of asset owners who want to move money. But I think there's also another component, which is just younger generations are also quite keen that the companies that they invest in and buy products from, are also not hurting the environment. They're also not buying sneakers from manufacturers who are using child labor. So I think that there's sort of some strong upward demand from the community for these trends. And what we're seeing in 2020, and we think the trend will continue into this year, is that significant amount of money has gone into renewables companies. So this is solar and wind in particular, as well as many of you will have known just last week. For electric vehicles, Tesla's market cap actually matched the market cap of all the traditional petrol automakers. And so I guess we can debate about relative valuations, but definitely what that shows is that there's a lot of confidence in one company's business model and a lot more uncertainty about another company's business model. So you asked the question about how we integrate this. I think that there's no shortcut. There's a lot of hard work involved. The approach that Fullerton has taken is that we have a specialist team of ESG experts who complement the research team, who now do a rating on each and every investment that we put money behind, and each and every company that we analyze. So our view is that this is not a fad, that this is an enduring trend.
Right.
Like what they say, this time is different.
Yes. Yeah. I guess picking up on your point that this is not a fad. I mean, it strikes me that the key trends that Ken has highlighted, in particular in Asia, they could be sort of a reinforcing dynamic here in the sense that as disposable incomes rise, you get more consumerism, you get more lifestyle choices. People then demand more innovative type products, as well as companies becoming more innovative. And I guess the younger generations, and maybe even as incomes rise, they become more environmentally conscious. So kind of everything sort of reinforces itself that companies that can navigate these trends can actually do quite well.
Yes.
Right.
That's right.
Okay.
I mean, the young is definitely different, right? Like my daughter is definitely very environmentally conscious, and really, like what Andrew said, would really support companies for good causes. Like my son, instead of buying goods to wear and with his friends, he preferred to buy virtual clothing on Pokemon Go.
Right.
So, I mean, that's quite bizarre for us to understand, of course. But indeed, the young generation is driving another wave of change in consumer behavior, which we want to position early on.
Right. And I think it's a key point too that a lot of people think, a lot of these trends have just changed because of COVID, but it's not solely down to that. A lot of these lifestyle changes, as you point out, have been building for quite some time.
It's been underlying, just that COVID has accelerated and compressed the digitalization and virtualization of our lifestyles.
Can I add a point too? It's interesting is that these trends where the re-rating of electric vehicle companies as well as renewables companies all happened during the tail end of a Trump administration who withdraw from a lot of global climate accords. So if we take the view that you now have a lot more unified view on the global stage from China to Europe to a Biden administration who will be soon taking over in the US, then a lot more stars are aligned. So my point was that even when there was some institutional forces against these trends, they couldn't keep them bottled up.
Right. That's a good point. Maybe if we pass back to Ken, and a point I think that Patrick first highlighted, that we're seeing the strong growth outlook, stronger earnings growth, of course, is coming through, and we're getting this Goldilocks environment. I suppose one thing that maybe is bugging investors, and we'll talk about valuation soon. But the other one, I guess, is will the rally broaden? And, a lot of people have highlighted concerns that it's been quite narrow so far, but in many respects, it's still early days, I think, in this rebound. I wonder what your take is on how the kind of broadening up of the rally will unfold.
Yeah, the rally has indeed broadened, as you can see, for the last quarter, right? And that is to be expected. And with China as a new engine of growth, being able to manage COVID very well, that is also leading the recovery of growth in Asia, in particular, as well as globally. Right. We see that as a really an investment opportunity to focus on, with Asia at the center, and looking at Asian-related growth opportunities. Be it Asian companies, listed in Asia, or even beyond that, meaning Asia-related companies as well.
Right. Because you do make a good point that I think the intra-Asia trade growth is actually stronger than global trade growth. And a lot of that, of course, is the importance of China.
Perhaps an interesting point indeed is that although we have very negative GDP growth in Asia, last year we actually had positive EPS growth, which is quite amazing. To take note of.
That's a good point. I think too, Patrick also highlighted in his presentation that even from a global perspective, the fall in earnings expectations was not as bad as what we had seen in the past when we had a more shallow recession, actually. That's very interesting. Maybe one other question sort of for both of you that before we tackle the valuation issue is, aside from the valuation, I guess, being the elephant in the room, are there any other particular risks that you worry about? Maybe we start with Ken. I know that people do worry about the US-China relationship, but are there other things affecting sentiment across equity investors?
I suppose now, with expectation built in, it's important that the market continues to have good earnings surprises to come, which we are very positive on in terms of earnings outlook for the full year. There's also this talk a lot about whether this is a bubble, right? Similar to bubbles in the past, especially relating to the 1999 TMT bubble, right? Which I was a fund manager then in the 90s. And going through that, we do see a lot of parallels. So bubbles, as you know, are typically formed in environments of abundant liquidity. And we have a rise of something new, a new thing that get people excited, persuaded, and convicted that this time is different. Right. And with more, or everybody begins to believe in a new paradigm that create a lot of frauds and excesses. Which that may be the case in some areas of the market, but we are very disciplined. We focus on what are the winners from this for many years to come. Just like some of the great companies that came out of the TMT bubble, many of which did not exist, should not exist, and of course many have disappeared. But indeed, you take a longer term view, what happened in the bubble, in hindsight, the opportunity set forth by the internet was grossly underestimated 10 years down the road, 20 years down the road, because it gives rise to new strategic opportunities and options, for the new, for the world to embrace. So we are, based on analysis, as you already pointed out, valuation is a concern. We have looked at the companies we focus on, and we can justify the current share prices, take a longer term horizon, 5 years, 10 years down the road. So we are not too perturbed.
Thanks, Ken. It could be a good segue actually for us to tackle the valuation issue before we go and look at some of the questions that the listeners have. Maybe Andrew, you could elaborate more on how to think about valuation in this environment.
Yeah, so we do get a lot of feedback about that this could be a risk, as maybe even in approaching bubblish conditions. But I think there's two very important things to keep in mind is that in any valuation of a stock, we have to look at the free cash flow or the earnings stream, which we think is going to have a very strong recovery this year because we've had coming out of a massive recession. The other is that the rate at which you discount those cash flows. So we also have a pretty high conviction that we're going to have low short rates, thanks to the Fed and other central banks who are committing for low rates for quite some time. And that means those two things together means that when you look at forward equity valuations, they look a lot more reasonable than the sort of static valuations approach. I guess the other lens I would suggest to look at is that within the market, and this is getting to Ken's points, is that right now there's a lot of disruption going on at the business model level and in terms of technology. So we also see within the market the differences between the high growth companies who can gain market share, who are gaining mind share in the minds of consumers versus the companies, which may perhaps had large moats around themselves in the past, but are now losing share. We're seeing a big bifurcation in terms of those valuations. And we think that trend persists just because there is a lot of disruption going on there. So to me, the average company is finding it a bit hard to grow fast right now, whereas there's a handful of companies who are able to grow very fast. And because of that, I think the key takeaway for investors is that one should get used to this big discrepancy in valuations within the market, unless those slower growing companies can find their mojo, can find some faster growth.
Oh, that's a very good assessment. I am thinking that we will have many questions from our listeners, so let's maybe see if we can tackle some of these. And I think, one of the maybe most obvious ones, and I might start with Andrew first, and then Ken can chip in, of course. I guess another age-old debate is what is going to win, the growth versus value.
Yeah. Well, I guess over the very long run, value stocks have outperformed, but in the last 20 years, growth has come roaring back, particularly in the last 10 years. So our medium-term view is that growth stocks are going to outperform. Okay. I think this year is a slightly trickier call because 2020, the initial recovery, coming out of the worst of COVID, was really for the work from home stocks doing quite well, which are kind of the secular growth stocks. I think this year will be a window where companies, even in financials, even in industrials, which are perhaps considered more old economy stocks, as long as they're not too disrupted by technological trends and business model trends, can have a window of opportunity. But I think the long term prize is still on the outperformance of growth stocks.
Yeah, I would echo that. And to add to what Andrew has said, essentially, growth is an area that still have a lot of opportunities, and growth is a very dynamic universe. Very different 10 years ago, 5 years ago, and now. Right. So in that regard, we do see that growth is evolving, unlike the value sector, which is typically pretty traditional, in nature. And hence, we find there's still a lot of new growth opportunities in a world that's full of disruption, as well as experiencing exponential changes. Right. That's quite key to us. Yeah. And what is value? It's a price to book one time, below one time is value. We take a different perspective. We look at growth opportunities, taking a 5-10 years view, and to us, there's a lot of value in these growth opportunities. Yes. Yeah, so I would like to reconcile this very important question.
I think that's the right way to think about the issue as well. And, this is another, I guess, interesting question too, which kind of harks back to when we were talking about the broadness of the rally and whether it's dominated by technology stocks. I guess this is again another concern that should we be concerned about one particular sector driving the rally and its valuation? Maybe Ken.
I suppose taking a broader perspective is that in central banks we trust, meaning that the macro volatility has been very well managed, and we would need that to remain the case going forward. So we have this liquidity environment to persist. That's point one. Point two is that we should look at companies with the right fundamentals, be it in technology sector, in consumer discretionary. Actually, it doesn't matter. What matters is that fundamentally, they continue to execute well, no matter what the environment has become, and continue to have good earnings surprises on the upside. So we can stay on course with the different milestones they can achieve as they drive from good companies to great companies and beyond.
Just to take a slightly philosophical tack on this, I think we've noticed is that technology, because it's so important to anyone's business, including our own. Look at how we're doing this event. I think so that you've already seen the index providers starting to break up the internet companies into various consumer discretionary and other sectors. I think there'll be a lot more of that. So some industrial companies are actually technology companies. There'll be fintech companies which may get put under financials, but they're technology. So I think that technology is a key component of every single sector, and if it's not a key component of the sector, then we have to worry about whether these companies are being disrupted.
Yeah,
Right.
and technology is quite ubiquitous. It's really purposive into all the different sectors,
Right.
rather than just technology per se.
I understand. Yeah, another key question, which I guess is not surprising, is what level of treasury yield would become stressful for markets? I always remember starting out as an economist that my professor always said, it's the rate of change, and the interest rate is a bit more important than the level that you hit. And I guess it is more difficult in this environment because we are starting from rock bottom, very low rates. So on the one hand, you could expect incremental changes maybe to be larger than otherwise. But I guess for my mind, the key adjustment has got to be back to inflation expectations, which could be around the 2% mark. I guess if we go beyond that, it could become stressful. But it'd be interesting to hear your guys' take on how much interest rate is too much, do you think? For the
Robert, I do agree that it's very much a rebasing of inflation expectation. But there's also this phenomenon about allocation shift from fixed income to equities. Like many of our participants have alluded to just now, right? That, of course, inevitably will lead to a rise in 10-year bond yield. And if indeed the funding environment is not too disrupted due to, as you said, accelerated movement up in bond yield, then I think equities market will do well and fine. So back in the 1990s, also you see a shift from bonds to equities, and equity markets continue to do very well in the face of rising bond yield. Of course, to a certain extent. I think we're still in the early days.
Yeah.
Well, I just add, I mean, I wouldn't argue with your professor. Surely a wise man or a woman. But I think that, so far what we've seen in the steepening of the yield curve and the 10-year yield going through 1%, which, let's face it, is still a very, very low level. I think that's pretty healthy and bullish for animal spirits. It's probably quite good for financial type stocks who have been performing a bit better. I think it would probably need to, double from that level before it became a significant concern. But the other thing why perhaps it's a bit different than the last major episode where we had rising bond yields, scare equity investors, which was taper tantrum, which I believe was 2013, was because we're pretty sure this time the Fed is not going to follow the rising bond yield with the short rates moving up. And therefore, that gives us perhaps a little bit more confidence that we can be in this environment whereby we have modest rises in long rates and equities can still do well.
Right, I think that's a great point. Well, thanks very much, Ken and Andrew, for sharing your thoughts. And I think we had a good discussion and also good questions from our listeners. We're going to transition to our last discussion, which is on alternative assets. The moderator for that will be my colleague from Fullerton, Charmaine Chin. And she will talk through the pros and cons, I guess, of investing in alternatives. What we're going to do is set it up again with a transition poll question for you. And it's what factor, if any, is actually holding you back from investing in alternatives? Thank you.
Thank you.
Hi, I'm Charmaine, Portfolio Manager for the Alternatives team. Alternatives is a large asset class that spans the risk-return spectrum from infrastructure debt and senior debt on one end to private equity and venture capital on the other end. Our panelists will discuss how investors can navigate the space and identify opportunities that they find attractive in today's market. We have with us here Tan Ha Kim, Head of Alternatives for Fullerton Fund Management. He oversees the external funds and private equity teams and also manages the firm's private equity portfolios. We also have with us Eddie Ong, the Deputy CIO and Head of Private Investments at Seatown. He's responsible for both private credit and private equity investments. Fullerton has a close relationship with Seatown as a sister company under Seviora Holdings, and we're privileged to have Eddie with us here today. But before we move on to the panel, let's have a look at the recent poll results and see what they indicate. So the question is, what factor, if any, holds you back from investing more in alternatives? And interesting, the largest group of responses comes in lack of experience in accessing alternatives. So hopefully we'll be able to address that in today's panel. So the first question goes to Hakim. What has been the impact of COVID-19 on the private markets? And what are some of the most attractive opportunities that you see today in the post-COVID world, particularly in private equity and in infrastructure?
Sure. Thanks, Charmaine. Firstly, I would say that private markets is not immune from any impact from shocks to the global economy. Just like public markets, private markets felt a dip during the onset of COVID-19. And towards the latter half of the year, it saw a recovery back to where it was pre-COVID times. But having said that, obviously there are still certain sectors which are facing challenging times, such as travel, retail. But by and large, you are seeing also bright spots coming from technology and healthcare as well. In terms of talking about attractiveness of the market, I would say that you have to look a bit more in the history of the disruptions, and that is where you can see certain lessons for us in terms of what to expect in the next 2 or 3 vintages. If you look at whether it's a GFC or Asian financial crisis or even oil shocks or Iraq war, you find that the next 2, 3 vintages are actually very attractive times for investing in private equity. Right. And the reason is very simple, because the fact is that private markets tend to take a longer term view of some of the investee companies and are able to look over these some of these short-term impacts on from COVID-19 on these companies, whether it's a supply disruption or temporary loss of a strategic direction, because ultimately these investee companies have got very good, strong fundamentals. Infrastructure, on the other hand, I would say it's a very interesting topic, right? So in terms of the boom market that we see, investors tend to veer towards the more sexy public markets and the returns that they offer. But infrastructure is something that people appreciate more during times of disruption because of its steady cash flows, the asset-backed characteristics. And so it becomes a bit more appreciated for its ability to ride through some of these cycles of the market. And interestingly as well, in this current environment of low interest rates, even the debt of infrastructure is very attractive, because exactly for those characteristics that it's able to show that asset-backed character, whether it shows a quasi-sovereign risk because of the concessions given by governments on the PPP contracts. So I think overall, I think it's getting more appreciated, especially times of a disruption.
Great, thanks Hakim. Now turning to Eddie and to private credit. Private credit's been a growing space over the last few years. Given the consensus that interest rates will stay low for longer and the demand for yield from investors, how do you think private credit can fulfill that need?
I think in today's market, if you look at from the very top-down view, right, I think private credit in general, especially in Asia, right, it commands typically a 200 to 300 pips of yield pickup versus a similar credit rating of a public listed bond for a company. Right. So that itself presents a form of a yield enhancement to a lot of investors. And then second of all, in a greater scheme of things, if you look at the traditional sources of financing coming from banks, that especially for mid-market companies, which they used to be getting access to, and right now I think that a lot of them are actually facing a lot of restrictions and a lot of pushbacks from these traditional sources, simply because I think banks in general are facing a higher capital charge on their balance sheet, especially when it comes to level 3 assets. And also profitability of banks has been on the decline given the low interest rate environment, and therefore a weaker balance sheet actually lends them to become weak in terms of providing financing to these mid-cap companies. And that's where private credit actually in today's context plays a big part, right, in fulfilling the needs of these companies. And because of the nature of the bargaining power that these mid-cap companies have, you see that private credit typically commands a much better pricing right? And typically you also get better credit structures, whether in terms of collaterals, whether in terms of loan covenants. So I think that's a spot where it throws up a lot of demand, and that's a spot where actually a lot of investors could get into the game of improving their returns.
Right. That demand creates that yield pickup that you
Exactly,
talked about.
exactly.
That makes sense. Okay, to Hakim. So question is, what should investors consider when they're incorporating private market investments in their portfolio, such as private equity or infrastructure? And what are the benefits of including such an allocation in their portfolio?
Sure. I think to answer that, we need to go back to the fundamentals of portfolio construction, because today alternatives is a very big market. It's grown much in sophistication, as well as matured a lot over the last 20 years. And I think you see that alternatives have roughly doubled every 6 or 7 years to the $10 trillion market that we see today. So I have had the privilege of advising investors on adding private equity to their portfolio in the past, and I would say that there's a gradual demystifying of that asset class as people get more used to the private markets and understanding a bit more of private equity. So the education has taken place over the years. However, I think that people should note that while it's a very deep market and there are probably sub-asset classes for every investor out there, whether you're looking for absolute returns or whether you're looking for an alpha over public markets, or even some of the steady cash flows that you're looking from, let's say, private credit or infrastructure, right? The market is huge, and whether you're a pension or insurance or retirement plan or even a sovereign, there is always something for each and everyone. So I think one needs to take a look at its stakeholders and what they're looking for in terms of requirements, in terms of their risk appetite, as well as their tolerance for illiquidity. So I think some of these factors need to weigh in, because in terms of the market, there is no doubt that it's deep and broad enough to find the sub-asset classes which meets the needs for the individual investors.
Understood. And for private credit, Eddie, what do you think investors need to consider when they're thinking about incorporating a private credit allocation into their portfolio?
Sure, like what Hakim has mentioned, portfolio construction is key. And I believe that every institutional investor or every individual, there will be a certain portion of the portfolio where they are willing to live with some level of illiquidity. Call it, some form of a core long-term holdings, right? And it's exactly this part of the capital that they have that typically, lends itself to investing in some product like private credit, which itself needs a bit more understanding, right? Because every single private credit, you're talking about the credit structure, it's important, the type of downside protection that you get when those, credits are being structured, it becomes important for the investor, and it helps in improving the risk reward for a typical investor.
Now, both of you mentioned illiquidity as a key consideration for investors in private assets. Do you think you can be more specific for our audience in terms of how long of a time horizon do you need to invest in private credit, private equity, or infrastructure?
Sure. I mean, different private credits, typically they have different strategies. I mean, you could have private credit that does more of the longer term, distress, special situations type investments. You have more of the mezzanine, which is private credit, which is typically also longer term in nature. And then there's stuff that invest in real estate, infrastructure, and even credits that focus on some region or some sectors in specific. So investor needs to look at typically what's a kind of like investment horizon. And investment horizon typically ranges from anywhere from like 4 to 6 years in the Asian private credit space, and typically longer when it comes to more developed markets in general, right? And also another feature where I think it pays for investors to look out for is the cash yield within those private credits, and how often do they throw up a dividend. You're talking about quarterly or semi-annually, because that would really impact the needs of investors. If they do have liquidity requirements, then they do need to customize their portfolio to specific types of private credit accordingly.
Right. There's some specific types of private credit strategies that throw off that annual or semi-annual
That's right.
coupon or
Yeah.
cash flow, right? That would certainly be attractive to I think
Sure.
many today in the low interest rate environment. And how about private equity and infrastructure? What sort of time horizon or illiquidity do investors need to take into account?
Sure. I think we need to understand that private equity and infrastructure are long-term asset classes. So therefore, the traditional way of investing into these asset classes is to invest in a 10-year horizon kind of fund. But having said that, the sophistication of private equity has improved quite a bit in the recent years. And so now we're seeing quite a bit of funds that are open-ended or shorter duration, or even, as Eddie mentioned, providing that liquidity through cash yields. So I think there's quite a bit of more options for investors today as compared to, say, 20 years ago. And I think we also need to understand what's that liquidity how do you define liquidity, whether it's in the form of redemption or it's in the form of, let's say, a steady cash yield. So to that extent, I think the market has improved so much that I think there's quite a bit of options for people to consider.
Thank you. Our final question to the panelists is, how can investors access the private credit markets, and how do they select the product that's most suitable for them?
Sure. I think for a start, I think investors should definitely talk to the folks in the market that knows about private credit well. I mean, understand the various nuances. As Charmaine, you have mentioned that there are different types of private credit, and there is indeed a lot of variations in terms of the kind of transactions that a specific fund in private credit may invest in. And the type of region comes with a different sort of a credit underwriting risk, right? So investors should understand that. At the end of the day, right, it will be a balancing act for an investor between getting enhanced return on those private credits that comes with higher returns, better collateralized structures, better loan covenants, and also probably one needs to understand how deep an analysis, what sort of a due diligence that a typical manager in that fund would undertake, right? Against probably the investor's liquidity risk requirement, right? If this liquidity requirement is higher, then you have to calibrate accordingly.
Right, that makes sense. And for private equity and infrastructure, how can investors best access those asset classes?
Yeah, I think we saw from the poll earlier that a lot of people are not getting into alternatives because of the lack of experience of investing in alternatives. And I echo a lot of what Eddie has just said earlier on educating yourself, because that's the key way of getting yourself familiarized with the asset class. And nothing beats research. And I also take the point on Eddie's point on saying that you should get a guide, basically to guide you through some of the opacity that is in an opaque asset class like private equity. Because it is so opaque, and even if you, let's say, decide to choose to go into private equity and you decide to go into a less risky part of a sub-asset class of private equity, such as buyouts, there are thousands of managers. Then before you start thinking about how to get in, you should be thinking of who, what, when, where, and why before you even want to think about how. So I think there should be some a seasoned practitioner, a good steward of capital who can guide you through some of these, help you analyze what your stakeholders are looking out for when they're investing in the asset class, right? And these people would be having your interest at heart and allowing you to take the interests of your stakeholders in consideration when you're investing in this asset class.
Thank you. Well, let's see if our audience has any questions for our panelists. The first question is, how can investors access opportunities in infrastructure debt? I think this is one that Hakim can take.
That's mine. Well, infrastructure debt has grown in maturity over the years. So infrastructure has been around for the longest time, and people have been investing in infrastructure, but what is less known is probably infrastructure debt. And over the last few years, there have been more and more funds that are raising infrastructure debt as well. And one thing that people are not aware is that infrastructure debt is now pretty safe, mainstream investment asset class. The default rate of infrastructure debt in this asset class is actually lower than investment grade over, say, a period of 10 years. So a lot of investors, especially the more sophisticated ones, whether it's the sovereigns and so on, are already piling into infrastructure debt. And there are a lot of opportunities that are coming up for people who are looking at alternatives to investment grade bonds.
Right. Sounds like it would be a nice complement or diversifier for an investment grade bond portfolio.
That's right.
Let's see the next question. The question is, do you see opportunities and risks for SPACs in Asia? This is a hot topic, certainly. And not sure which one of our panelists wants to say
Sure,
this.
I can take a stab at it.
Okay.
Right. I mean, if you look at SPACs, I mean, typically you raise a bunch of money and then you start looking for opportunities.
Right.
I think the risk here is, I think for a lot of investors, they need to understand who will be the SPAC manager and basically what sort of expertise and track record they have in terms of acquiring those assets. I think from time to time, as we have seen during the COVID environment, there's major dislocation. There is points of stress in terms of liquidity that where basically a SPAC manager having raised a sum of money would be able to capitalize on.
Right.
Right. And that's something that we see from time to time. But again, I think track record is important. The type of industries that the managers have expertise in should be considered because you know, when you talk about SPACs, you're talking about like an acquisition, right? Typically, you have a control of the company, and you need to some extent, right, be pretty involved, right, in basically managing some of the management and operational expertise within the firm, and that's something that I think the investors would really need to consider when they're backing a SPAC.
Right. I mean, SPACs have raised a record amount, particularly in the US this year, but I think even in Asia, they're becoming more and more popular.
That's right.
Sounds like we have another question from the audience. Are investors adequately compensated for the longer lockup term, and what sounds like looser loan covenant structures? So I think this is specifically for private credit, where there's been some concern, certainly, and a lot of articles written about these looser loan covenants.
Sure. I mean, I think half-light loans over the years has been pretty fashionable.
Right.
And how they came about largely was because of the continued declining rates environment, right? Rates have stayed low. 10-year treasury is just slightly over 1%. And I think relative to what the public market offers, I think to some extent the private credit markets would have to move in tandem with what the public market is probably offering up right now. And covenants is something that it's kind of like a bargaining process, right? When you lend to a private company, depending on the strength of the company in terms of its ability to access other avenues of credit, you will be able to demand certain stronger covenants if the bargaining chip is on your side, and you can put in probably tighter collateral demands, and all that. But I think in the case whereby if their access to other forms of credit is easier, then you would lose that ability to actually put in stronger covenants.
Right, and that's probably one of the key differences, right, between public credit and private credit.
Exactly.
It's the how tight of covenants you can negotiate.
Sure.
Right. We have one question here, which should be interesting. How should investors split their portfolio allocation between private equity and private credit? So who wants to take that one first?
I'm happy to take that. I would say that in general, if you look at the private equity market, it's obviously a bit more mature and larger in size in comparison to the private credit. But I reiterated the point that investors should be looking out for their stakeholders and having their interests in mind. Because private equity may not be for everyone, nor private credit is for certain people. So I think one needs to take a neutral ground and sort of see how some of the sub-asset classes within private equity and as well as a private credit fit into the portfolio within the portfolio construction. Whether you're able to take some of the illiquidity, whether it's from private equity or private credit, to that extent, I think there are certain commonalities in terms of illiquidity, but also some commonalities in terms of the alpha that you're expecting from these two asset classes. So I think people need to sort of look at their stakeholders first before deciding how they should be splitting up their portfolio.
Thank you. Well, thank you both for your insights on alternatives, Hakim and Eddie. It gives our audience clarity on the opportunity set, the benefits of alternatives exposure, and ways to asset the asset class. And before I hand it back to my colleague Robert, let's have one last poll for the webinar and see what our audience is thinking for 2021.
Well, welcome back, everyone. I think we've seen a very interesting webinar, and there's been many key takeaways, I think, for investors. What I'd like to do in terms of wrapping up and summarizing is just to highlight, I think, 4 issues, one issue from each of the panels that we've seen today. I think the key point from Patrick was that the growth outlook is very strong. The consensus and the IMF is expecting above average growth for the next few years. And at the same time, inflation is expected to be contained. Liquidity growth has also been very strong. So these 3 factors Patrick highlighted to us as creating an investment environment that can be very favorable for investors, like a sweet spot or a Goldilocks environment. Against that backdrop, we heard that the equity team is also very optimistic. They highlighted that the firms that can do the best are those that are best able to increase their market share and navigate the key trends of rising consumerism, more life choices, technology, and of course the green engine. Across the fixed income space, we heard that the team is particularly optimistic about Asia and especially corporate credit, high yield, maybe can perform quite well this year in a low rate environment. The fundamentals for Asia are particularly strong because we have the high real yields and favorable growth outlook. And then summing up the last panel, the alternatives team, it was interesting from the get-go that one of the key, I guess, limiting factors as to why investors hold back from alternatives is a lack of experience in this asset class, which I guess is understandable because it is quite new. But the team did emphasize that there are opportunities, especially in infrastructure, and there can be quite a favorable risk-reward balance for investors. So I think given that backdrop, it's quite useful for us now to go and see what is the key risk that were on people's minds for 2021, and our poll results in front of us. So we have quite a split, I guess, across interest rate is one high risk, but I guess not surprisingly, the dominant concern is the pandemic is in relation to COVID-19. Maybe we get disappointments on vaccine, maybe return back to lockdowns. So I think that maybe understandably this is the key risk because people are worried that we will go back to lockdowns like what we saw last year, and that could be quite stressful for markets. But I guess the other thing to think about if that risk does materialize is it would certainly increase the pressure for policymakers to do more, to give more stimulus. A lot of the investment views that we discussed today are actually presented in an online publication that you can all access if you just go to the QR code that is on screen now. We really thank you for your time and hope you got a lot out of the webinar. We really thank you very much for our support, for the support from you, and we hope that you have a good year. Thank you.